the crisis in the Middle East, Israel, Iran, seems to have calmed down for now. What are you telling investors, though? Are these geopolitical risks, especially the oil, I mean, is everything safe now or not?
No, I wouldn't say everything is safe, but I think it's certainly good news what has now happened. If you look at the oil price, right, we are back to the levels we have seen before this escalation in the Middle East, which I think is good news. A higher oil price is always, I compare it to a tax hike. So if you go back to the same levels, I think from that perspective it's positive news. And I would be saying in the next weeks, probably we see no further escalation at this point in time, which I think markets would like that. And we see that.
Why are you so optimistic, though?
Because I think there will be negotiations necessary, but for the time being, I think we have seen that massive escalation, and now this has been brought to bed for the time being. I'm not saying it's over. Yeah, but I think for the time being, markets should be a bit calm on this. And we have seen the reaction, right? As I said, oil price has been coming down. So from that perspective, I think it's good news.
So you're confident that they're going to start talking to each other again, as opposed to firing missiles at each other, which can only be a positive thing. On the oil market reaction, though, were you surprised? Let's say if we compare to similar sort of crises in recent modern history, Arab oil embargo, etc. We had back then oil tripling, in some cases quadrupling in price. The move we just saw in the past week, high to low is about $18, actually pretty subdued compared to what we've been used to in the past. Why has that been?
I think the market was not, say, very scared by the Middle East escalation, right, which was quite interesting to see. If you look at equity markets, yes, there was a little drop. Oil prices, yes, as you say, were higher, but the market was, I think, looking through this a little bit, which now seems to be the right way, so you can say the market was very rational. We also looked at oil and risk scenarios, right? So for us, it's always, and still is, if you look at from the oil price perspective, is always this topic of, is there a closure of Strait of Hormuz or not? And if that were to be closed, we would expect oil prices to be above 120.
Easily, yeah.
So, and from that perspective, that's, I think, what we watched. That didn't happen at this point in time, and that's why we saw the oil price coming back to the levels we have been seeing before. But indeed, I agree. So especially oil price was moving higher, but not as much as in the past, and other markets were relatively calm on this.
Okay, so we'll put physical war aside for now and talk about the trade war, which has still been underneath and sort of looming over things. I want to ask you, we had the White House overnight suggesting or hinting that, hey, that July 9th deadline for the reprieve on reciprocal tariffs to end may not be a hard deadline. The president may be willing to extend that. If that were to happen, would you be surprised?
I would not be surprised, but first I also want to see that really happening. So I think first there's a lot of focus on the Big Beautiful Bill Act, which should be done by July 4th latest, maybe a bit earlier. I think then the focus also of the markets...
You're confident it can be by the 4th of July?
I don't know. I think they need to get this done, right? I think they want to make it before their big celebration of the 249th birthday of the US, so I think that's a hard deadline in a way. Yeah. It would be positive, I think, for markets if that's out of the way. There's a lot of discussion about Section 899, where Besson said maybe we take this out, which I think would be positive news, also for flows into treasuries. And I think then focus will turn back to trade. And there's a lot of discussion with Japan and especially European Union. I have not heard that there's an agreement at this point in time, so I doubt, if I may say, that there would be one by July 8th or 9th. And then you need, of course, some solution to this, and that could be a prolongation or not, but that could be causing volatility in the markets, I think.
You mentioned yields easing back, and let's take a look at how the 10 is pricing right now. We're cleanly sub 430. I think we're about even sub 425, 424. And this is as we enter the second half of the year and look forward to, if you want to look at it this way, continued record issuance by the Treasury. So why are yields easing, do you think?
Yeah, I think it's a bit looking at the growth side as well. So growth has been coming down, and we don't expect a massive boom in the US. So our forecast would be 1.2, 1.3% for this year. I think what's very important, though, from our perspective is inflation data as well. That has been easing, but we do expect inflation to move higher in the third quarter. So we wouldn't be surprised if we see in the US 3 point something on inflation. And from our perspective, I would say yields could go slightly higher. So our forecast would be 450 if you look in 1 year's time, which is not massively higher from now, but it's higher from now. I think that's very important.
Yeah, directionally not the way that President Trump would want to see that go, right? Which is probably why he continues to pile pressure on Fed Chair Jay Powell. And this is it's become almost relentless, right? And folks in the market now, I think it was in the Wall Street Journal, they were saying that he could start talking about who is likely to succeed Powell. Waller, Warsh, a couple of names have been thrown out there. And it raises the risk that, if this happens too far ahead of May when Powell's term actually expires, you could end up having a situation where there's a shadow Fed and a shadow Fed head. And the market's going to go, okay, so who do I listen to? What are your thoughts on that?
Yeah, I think President Trump has said he wants to appoint someone quite early. I agree. And I always hear September, October, which is quite far in advance. Yeah. But still, I think the market would look in the FOMC and knowing there's maybe one person coming up. But I think I would look at the decisions in the FOMC, which will not change then substantially with the chair.
It's a committee.
It's a committee, and not everything can be changed immediately. There's, I think, one change at the beginning of the year. One governor is exchanged, but otherwise there's not much change until May next year. So I would not look too much at this kind of shadow.
So it's not a foregone conclusion, is what you're saying, that the market is going to get as many rate cuts or as soon as they would prefer to see.
Yeah, I would be a bit, let's say, not careful, but I would not be too optimistic of too many Fed cuts, because, as we're saying, inflation is probably moving higher, yields are not substantially coming down. Yes, we also think there will be Fed cuts because of lower growth, but if you price too many, I think that was also wrong in the past. We have always advocated for higher for longer, as we call it, for yields, and so far that has not been wrong. And what we see on trade, although we find maybe solutions, which is good news, tariffs are still higher. So I still think it's inflationary.
Sorry? Are they going to cut in July, do you think, as soon as that?
No, I don't think so. I think it's rather September.